picture this scenario. You're at a coffee shop, right?
Right.
And you hand your unlocked phone to a friend so they can pick a song on your Spotify app.
Yeah, completely normal thing to do.
Right? No big deal. The stakes are practically zero. Now, imagine you hand over that same unlocked phone, and out of the corner of your eye, you see them open your banking app.
Oh, instantly terrifying.
Exactly. Suddenly, your heart rate spikes. You lean over. You want to know exactly what they are doing, like what buttons they're pressing and where your money is actually going.
Well, the dynamic shifts instantly because you are crossing this. I mean, it's a massive psychological and practical line.
Mm-hmm.
You're moving from a completely harmless, low-stakes interaction into a realm of direct financial exposure.
Right.
The trust required isn't just about, whether they have good taste in music anymore.
Yeah.
It's about whether they are going to accidentally wire your rent money to a total stranger.
And that exact shift in the dynamic is happening right now, like at a global scale with artificial intelligence.
Yes, absolutely.
We are currently watching AI graduate from being this really impressive conversational tool, or a chatbot that writes a clever email or summarizes a dense PDF into an active economic actor.
Yeah, it's taking action.
We are actively deploying autonomous AI agents into the wild that can write code in live production environments, handle complex tax filings, and even execute thousands of dollars in financial trades on your behalf.
Which forces a fundamental reevaluation of what the word safe even means in the context of artificial intelligence. I mean, we are entering a phase where a polite, helpful AI is no longer sufficient if that same AI can, bankrupt you.
Yeah, bankrupt you. That brings us to our focus for this deep dive. We have a mountain of sources today, but the centerpiece is this highly detailed, incredibly prescient research paper.
A great paper.
It's titled Quantifying Trust Financial Risk Management for Trustworthy AI Agents. And the author list is just a powerhouse collaboration. We're talking researchers from Microsoft, Columbia University, Google, DeepMind, and a handful of other top-tier institutions.
The ambition of this paper is really hard to overstate. Our mission today is to explore a paradigm shift they're proposing for the entire digital economy.
Okay, let's get into it.
Because for the last several years, the tech industry has been obsessively focused on internal safety. The goal was to fix the model itself.
Right, training it to be robust.
Exactly. Mitigating its biases, patching vulnerabilities so it couldn't be jailbroken into giving dangerous instructions. But this paper argues that internal safety, while it is important, has basically hit a wall.
A brick wall.
Yeah. We're moving toward a reality where we have to build actual financial safety nets around the AI's real-world actions, using mechanisms like escrows, collateral, and underwriting.
And the researchers actually coin a term for this wall we've hit. They call it the guarantee gap.
The guarantee gap, right.
To really grasp this gap, we have to acknowledge a hard, basically unavoidable truth about how large language models function. They are inherently stochastic.
Meaning they operate probabilistically.
Right. They don't retrieve information from a database like a search engine does. They calculate the statistical probability of the next word in a sequence. So you can optimize them, you can align them with human values, and you can give them massive guardrails.
Sure.
But you can never mathematically eliminate the chance of a failure. You just cannot train out a 100% failure rate.
And the implications of that stochastic nature are profound when you start plugging these models into the actual economy. Think about the stakes here.
Right.
If you ask an AI to generate a recipe for a dinner party, and it hallucinates an extra cup of salt, the downside is a ruined batch of soup.
Yeah, you just order a pizza and move on.
Exactly.
Yeah.
But if you unleash an autonomous tax filing agent and it hallucinates a single digit on your capital gains declaration, the consequences are severe. That one digit triggers IRS audits, thousands of dollars in financial penalties, and potentially years of legal headaches.
A completely cascading failure stemming from one statistical misfire.
And that is the guarantee gap in action. The researchers highlight that users, meaning you, the listener, or a Fortune 500 company, will simply refuse to adopt high-stakes AI if the downside risk is completely unbounded.
Right. No sane enterprise is going to deploy an autonomous trading bot if a single hallucination could wipe out their quarterly earnings.
No way. You cannot build a durable digital economy on crossing your fingers and hoping the model doesn't hallucinate today.
It feels very similar to the evolution of car safety, actually.
Oh, how so?
Well, currently, the AI industry's approach to safety is entirely focused on the vehicle itself. They're building better anti-lock brakes, more responsive steering, advanced lane departure warnings. That is model internal safety. and it's fantastic.
Right. It's necessary.
But if you were going to put your entire life savings in the passenger seat of an autonomous vehicle that you know has a non-zero chance of malfunctioning, you don't just want world-class brakes.
No, you want a safety net.
You want a comprehensive car insurance policy that pays out if a crash happens anyway. You need a product-level guarantee that bounds your financial loss.
Exactly. We have to build a system that financially guarantees the outcome when things inevitably go wrong, because we cannot perfectly predict an AI's behavior. The entire ecosystem needs to pivot.
Pivot from what to what, exactly?
We have to move away from an implicit expectation about how the model should behave and move toward an explicit, legally enforceable contract about what happens when it misbehaves.
Which begs the obvious question, right? How do we actually build an insurance policy for a piece of software that thinks probabilistically?
Well, the researchers propose borrowing the blueprints directly from Wall Street. They introduce a comprehensive framework they call the Agentic Risk Standard, or ARS.
The Agentic Risk Standard.
Right. ARS takes the bedrock mechanisms of traditional financial markets, tools like construction bonds, escrow accounts, and clearinghouses, and translates them into the world of AI transactions. It creates a standardized way to price and manage the risk of autonomous actions.
And the genius of ARS, honestly, is how it splits AI tasks into two very distinct categories to manage that risk. The first category is what they call fee-only tasks.
Okay, give me an example.
Let's say you hire an AI agent to research market trends and generate a 50-slide deck for a crucial presentation, and the service fee for this AI is $50.
Got it. In that scenario, your risk profile is very limited.
What?
Your only real danger is non-delivery, like the AI just crashes and doesn't do it, or it delivers a completely useless, hallucinated slide deck.
Right.
Crucially, you haven't given the AI access to your bank account. You've only promised to pay it a fee for a service.
So ARS solves this category with a classic escrow vault. You authorize the task, and your $50 gets locked in that vault. The AI goes off, does the research, generates the deck.
Right.
Then an evaluator, which could be another AI or a human, verifies that the deliverable meets the original criteria. Only after verification is the $50 released to the AI provider.
And if the AI hallucinates nonsense?
The evaluator rejects it, and your $50 bounces right back to your wallet. It's elegant and simple. But the second category is where the complexity just explodes. They call these fund-involving tasks.
Yes, the fund-involving tasks.
This is when the AI agent requires direct access to your actual capital before it can execute its job. Think about instructing an AI to manage a currency exchange or rebalance your stock portfolio.
The entire risk paradigm shifts here, because the AI is no longer just working for a fee. It is wielding your money as a tool.
Wait, hold on. A $50 escrow doesn't help me at all if the AI just vaporized my $10,000 principal.
Not even a little bit.
Like if I let an AI agent trade 10 grand for me and it hallucinates a decimal point and buys the wrong asset class entirely, my money is completely exposed. Getting my $50 service fee refunded while I watch my life savings disappear is cold comfort. Escrow alone is totally useless for a fund-involving task.
You've hit on the exact vulnerability the researchers identified. And it is the entire reason ARS introduces a second layer of protection called the principal track.
The principal track.
Escrow is strictly for the service fee. The principal track is specifically designed to build a fortress around your core funds.
So let's get under the hood of this principal track. How does it actually build that fortress?
It requires introducing a brand new entity into the digital economy, a financial underwriter. Let's walk through your currency exchange example using the ARS state machine.
Okay, my 10 grand to Canadian dollars.
Right. You tell your AI assistant to exchange the 10,000 US dollars. Before the AI is allowed to touch a single cent of that $10,000, it must send a request to the underwriter. The underwriter's job is to assess the specific risk of this specific AI agent attempting this specific task.
So the underwriter is looking at the AI's track record. They're analyzing how many times this specific model has successfully traded currency versus how many times it has crashed or hallucinated an error.
Precisely. The underwriter calculates a risk profile. Let's assume the underwriter determines this is a highly reliable agent, but because it's an LLM, the risk is never zero.
Right, it's stochastic.
Exactly. So the underwriter agrees to insure the $10,000 transaction, but demands two strict conditions before giving the green light. First, they require a premium paid by you, the user, to fund the insurance pool. Let's say that premium is 20 cents.
Okay, reasonable.
Second, and more importantly, they demand collateral from the AI service provider. The company that built the AI must lock up their own capital, say $1 in a smart contract.
Oh, wow. So the AI company is forced to have actual skin in the game. They have to put their own money on the line every single time their agent acts on my behalf.
Yes. If the AI successfully executes the trade, the collateral is released back to the provider and everyone is happy. But if the AI malfunctions and buys $10,000 worth of useless penny stocks, the ARS system triggers a liquidation.
And slashes the collateral.
The service provider's collateral is slashed to help cover the loss, and the underwriter pays you a reimbursement to make you entirely whole. Your $10,000 principal is protected.
So I pay my 20 cents, the AI company locks up their dollar, and the trade happens. But we have to address the friction here.
Friction is the big word, yes.
What if the AI company looks at that $1 collateral requirement and refuses to lock it up? Or what if I look at that 20-cent premium and decide, I simply don't want to pay for insurance on a trade I feel confident about?
The paper anticipates this exact bottleneck and outlines an explicit human override path.
A human override.
Yes. If the underwriting terms are generated and either the user rejects the premium or the service provider rejects the collateral, the entire transaction hits a hard stop. The ARS state machine pauses. The transaction cannot move forward unless the human user explicitly manually signs off to accept the full, uninsured pre-execution risk.
Okay, I have a serious problem with this design. The researchers just spent all this time building a brilliant, elaborate safety net with underwriters, collateral, and escrow vaults just to install a giant red override button that lets the user jump without the net anyway.
It does seem a bit wild.
Doesn't giving the user the ability to bypass the system entirely defeat the purpose of building the safety net in the first place?
It seems counterintuitive, I know. But the override is actually a crucial feature of a functional economy. ARS is not designed to be an authoritarian dictator that blocks commerce.
Then what is it?
Its primary function is transparency. By forcing the system to pause and demanding a manual override, ARS drags the hidden risk of stochastic AI out of the shadows and places it directly in front of the user. You are no longer blindly trusting a black box model. You're being forced to consciously acknowledge the downside and make an informed economic choice to bear that risk yourself.
You know, it functions almost exactly like the security warning on a web browser.
Oh, that's a good analogy.
Right, when you try to visit a website with an expired SSL certificate, Chrome throws up that giant red warning screen. You absolutely can click the tiny text that says, proceed to unsafe site anyway, but the browser has fulfilled its duty. It quantified the risk, presented it to you, and forced you to take manual responsibility for your actions.
A very apt comparison. A rigid system that doesn't allow for flexibility will simply be abandoned by the market. There are messy, real-world scenarios where the override is necessary.
Like what?
Well, you might be using a highly trusted internal AI tool built by your own company's engineering team. Demanding collateral from your own IT department makes no sense. The override button prevents the safety framework from becoming a straitjacket.
Okay, speaking of the market abandoning the system, this brings us to a massive hurdle. In theory, this framework sounds airtight.
In theory, yes.
But in practice, introducing insurance premiums and demanding capital collateral creates incredible friction. You're adding steps, you're increasing the cost of doing business, and you are forcing tech companies to lock up vast sums of liquid capital just to operate their models.
That's a huge burden.
And the researchers knew they couldn't just publish a theoretical white paper, right? They needed to know if this friction would kill the system in a live marketplace. So they ran a massive simulation.
Right, they moved from financial theory into rigorous empirical testing. They built a 5,000-episode simulated digital economy.
5,000 episodes. Wow.
Inside this environment, they modeled the behaviors of users, AI merchants, and a central underwriter. They meticulously adjusted the parameters over thousands of runs. They tweaked the false positive and false negative risk assessment rates of the underwriter. And they experimented with different sigmoid functions to see how steeply the collateral requirements should scale based on the risk.
And the data revealed a brutal, basically unavoidable trade-off. They found that when the underwriter charges a high loading factor, which is insurance terminology for charging higher premiums to build a massive safety cushion, and demands extremely steep collateral from the AI providers, the system works perfectly from a safety perspective.
Perfectly safe.
Right. The users are completely protected, the underwriter remains solvent, and zero catastrophic losses occur. However, that high-friction environment completely crashes the adoption rate.
The economics simply break down. If the insurance premium costs more than the perceived value of the task, Users will either aggressively click the override button or they'll stop using AI agents entirely.
Naturally.
Simultaneously, if the collateral requirements are astronomical, AI companies will find it too capital-intensive to offer the service, and they will pull their agents from the market.
Which leads to a really depressing initial conclusion. Like, does this data prove that making AI agents financially safe inherently makes them too clunky, expensive, and burdensome for everyday adoption?
It kind of looks that way at first glance.
Did they just prove mathematically that we are building a beautifully secure vault that no one will ever actually bother to use?
If you only look at the adoption rate, you might think so. But delving deeper into the simulation data reveals something phenomenal, a metric they call the failure reduction rate.
Okay.
The researchers discovered that the friction of collateral isn't a bug that kills the system. It is the most powerful feature of the entire framework.
Let's unpack the mechanics of that. How does a failure reduction rate turn friction into a feature?
Because when you force AI providers to put their own money on the line, even a seemingly insignificant amount, it radically alters their operational behavior. The simulation demonstrated that the collateral requirement acts as an incredibly effective filter against shoddy, high-risk AI agents.
Oh, I see where this is going.
Bad actors or companies employing highly hallucination-prone, untested models simply cannot survive in an ARS environment. They cannot afford to post collateral over and over again if their models continually fail, hallucinate trades, and trigger collateral liquidations.
That is the ultimate aha moment of this entire paper. The underwriter isn't just an insurance agent. The underwriter is acting as a system-level bouncer.
Yes, a bouncer.
It actively deters bad agents from even attempting to execute tasks in the economy. Even in the simulation scenarios where the adoption rate dipped slightly because of the added friction, the overall health, safety, and integrity of the digital marketplace skyrocketed. The sheer number of failed transactions plummeted because their risky, unreliable agents were financially priced out of participating.
It forces market-driven hygiene. It perfectly aligns the financial incentives of the AI provider with the safety requirements of the user. If your AI is reliable and safe, your collateral is constantly returned, your overhead remains low, and you dominate the market.
Then if it's not?
If your AI is sloppy and dangerous, your collateral is drained, your operating costs explode, and you go bankrupt.
It's not just about protecting the user who gets into a crash. It's about getting the dangerous drunk drivers off the road entirely because they literally cannot afford the insurance premiums required to turn the ignition. It cleans up the entire ecosystem.
Beautifully put.
But we have to ask how this actually functions in the real world. ARS is a standard. It's a set of rules and state machines. It is not a bank, it doesn't hold the money, and it doesn't verify my identity. How does ARS physically plug into the digital economy we're already using today?
Well, ARS is engineered to be highly modular. It functions strictly as a settlement layer.
Meaning it sits in the middle.
Exactly. This means ARS completely abstracts away the physical movement of money and the initial identity verification. It's designed to sit directly in the middle of a transaction stack, interfacing with other specialized protocols.
And the paper actually maps out this modular stack, and it shows how ARS integrates with emerging technologies that tech giants are building right now. For example, it relies on protocols like Google's AP2, which stands for Agent Payments Protocol, or MasterCard 6, which is verifiable intent.
Right. And to grasp how ARS works, you really have to understand what protocols like AP2 and VI are doing. They utilize advanced cryptographic proofs, specifically things like selective disclosure tokens, to verify that a human user genuinely authorized an AI to take an action and strictly defines the boundaries of that action.
Let's demystify a selective disclosure token for a second. Think about going to a bar and handing the bouncer your driver's license. The bouncer only needs to know that you're over 21.
Right.
But by handing over your physical ID, you are also revealing your home address, your height, your weight, your organ donor status. A selective disclosure token is like a magical ID that only proves to the bouncer that you are over 21 without revealing a single other piece of information.
That's a perfect analogy.
So in the AI economy, AP2 uses these tokens to prove to a merchant that you authorized a $1,000 flight purchase without revealing your entire banking history or your login credentials to the AI.
That cryptographic authorization is the crucial first step. Google's AP2 or MasterCard's EQCs handles that initial verification. Once they cryptographically prove that you authorize the AI to buy the flight and that your budget is capped at $1,000, they pass the transaction to ARS.
It operates exactly like a relay race.
Yeah, exactly.
The authorization protocols run the first leg. They prove intent. Then they hand the baton to ARS. ARS is the referee standing in the middle of the track. It takes that verified authorization, locks the $50 service fee in the escrow vault, contacts the underwriter to calculate the premium for the $1,000 flight risk, and forces the AI provider to lock up their collateral.
It coordinates everything.
ARS orchestrates the entire risk management state machine, and only when every single condition is met, only when the underwriter gives the green light, does ARS hand the baton to the final runner.
And the paper uses an HTTP native payment protocol called BY402 as the perfect example for that final leg. ARS gives the signal, and BY402 physically executes the transfer of funds across the internet, moving the money from your bank to the airline.
Authorization, settlement, execution. A beautifully segmented, perfectly modular system.
The elegance of the researcher's design lies in its pragmatism. ARS isn't trying to boil the ocean. The authors aren't proposing a massive disruption where we have to replace the global financial system, invent a volatile new cryptocurrency, or dismantle MasterCard.
Right, they're working with the existing structure.
They recognize that traditional finance is incredibly rigid. A bank ledger is deterministic. You either have the funds or you don't. Traditional finance does not understand a 99% probability of transferring funds.
No, it definitely doesn't.
So ARS acts as the vital, shock-absorbing gear that translates the unpredictable, probabilistic nature of AI into the hard, deterministic rules of traditional finance.
Let's pull all of this together for you, the listener. Trust in artificial intelligence is undergoing a massive structural evolution right now. For the past decade, we've been endlessly fascinated by the psychology of the model. We constantly asked, how does it think? Is it biased? Can a clever prompt trick it into writing malicious code?
We were looking inward.
Right. But as we hand these agents the keys to our digital wallets, the entire conversation is shifting. We are moving away from worrying about how the model thinks, and we are being forced to define exactly who pays when the model inevitably breaks.
It is the necessary evolution from implicit, blind trust to enforceable mathematical economic guarantees.
So the next time you're tempted to hand over your credit card number, your API keys, or your investment portfolio to an autonomous AI tool that promises to make your life easier, you shouldn't just be looking at its benchmark scores and asking, is this model smart?
No, you need to dig into the terms of service, look at the architecture, and ask, who holds the financial liability if this model makes a mistake?
Because if the system isn't designed to hold the provider liable, and the answer to that question is you do, then you are jumping out of an airplane without a parachute.
It's just too much risk.
But this entire framework leaves us with one final, incredibly thorny question to mull over. The ARS paper is a brilliant solution for bounding direct, calculable financial loss. If the AI buys the wrong stock and loses $10,000, the math is simple. The underwriter slashes the collateral and reimburses you $10,000. The ledger balances.
Right, money is easy to quantify.
But what happens when an autonomous AI agent is given access to your medical records to schedule a sensitive surgery, or it reads your private emails to draft replies, or it manages your social media accounts to build your brand?
The mathematical elegance of the ARS framework shatters when you introduce non-monetary harms.
How will the future underwriters of the digital economy ever manage to price a premium or calculate the necessary collateral for damages that don't fit on a spreadsheet? What is the exact financial payout for a completely ruined reputation?
Or a devastating privacy breach that leaks your private messages. Or an AI hallucinating a missed medical diagnosis. You cannot simply put a $50 escrow vault on a privacy violation.
No, you really can't.
That is the next great unsolved frontier of AI risk management. We are finally figuring out the mechanics of how to insure the wallet. But ensuring the human impact, the reputational and physical damage of autonomous agents, is a massive problem we haven't even begun to untangle.
So before you hand that unlocked phone to the AI, make sure you know exactly what it's allowed to tap and exactly what you stand to lose.